If you love handing over money to the ATO and prefer to pay way too much tax than you legally have to, then this video is not for you, because I'm going to show you 4 simple but powerful ways you can change the way you calculate your investment taxes. This is 100% legal. How do I know this? Because I run Navexa, Australia's highest rated tax automation platform. We track over $2 billion in investments across thousands of Australian investors, which means I live and breathe tax reporting because it's my business. So by the time you finish watching this video, you'll be able to drastically affect the tax outcome of your portfolio this financial year. Number 1, the CGT concession rate. One of the big things investors get wrong all the time is not taking advantage of the CGT concession, or to put it in layman's terms, the 50% off discount you get for holding shares longer than 12 months. Let's say in this example, we bought $10,000 worth of shares. Later, we sold $20,000 worth of shares, and that gives us a $10,000 capital gain. Now, let me illustrate how much of a big deal selling too early can have. So let's say the original buy was here, and this line represents 12 months. Now, if we sell the shares here, we're going to realize that full $10,000 gain and pay tax on that. So if we look at an average tax rate of, say, a third, you're going to pay about $3,333 on that gain. Now, let's for a moment say we held it for longer and we sold it here at 18 months or 2 years or something beyond 12 months. What happens now is that $10,000 is taxed as if it was $5,000. Ignore my terrible writing, shaky hands. Now, instead of paying the $3,000 in tax on the $10,000 gain, we're going to pay roughly a third of $5,000. My maths isn't super good on thirds on $5,000, but it's a lot less than $10,000. So you can see in this example how important it is to factor in the 12 months. A lot of people fall into the trap of buying something they shouldn't and then selling it too early. And then not only was that a bad decision for buying it, a bad decision for selling it, they now realize the full amount for capital gains. Whereas a good investor is going to buy something for the long term, they're going to hold it well past 12 months. And then when they sell it, they get a nice 50% off their capital gain. Number 2, selling the wrong parcel of shares. Now, if you've bought multiple times into the same stock in the past, and then you sell at some point in the future, it gives you quite a bit of flexibility over which parcel you want to sell. And that can have quite a big tax impact when it comes to tax time. So let me show you here on the whiteboard what I mean. We've got a timeline here, and at some point in the past, we bought 10 shares at $1. Then another point in the future, we bought 10 shares at $5. And then we bought a third parcel of the same stock, 10 shares at $3. So we've got our 3 different cost bases of $10, $50, and $30. Now imagine 2 years down the line, we want to sell 10 shares. So we're not selling the full amount because we own 30 shares. We're selling just 10 at $4 a share for $40. The default strategy a lot of people use is FIFO. It's pretty standard internationally, and it's the default one people use because it's super easy. The problem with FIFO is it means you calculate the gain off the earliest shares you bought, which are usually way cheaper than what you sold it for. So in this case, if we were using FIFO, we'd calculate the gain, because remember, capital gain is the sale minus the original buy gives you the gain. So in this case, our $40 minus 10, this is the first parcel, would give us a $30 capital gain. If, let's say our goal was to pay the least amount of tax possible, we could then use another common strategy, which is the LIFO strategy, or last in, first out. Now, people often like this one because usually the most recent shares you bought in that stock will be the similar price. So it usually will often result in a lower gain than using a FIFO strategy. So in that example, we'd take our $40 and we'd use the last parcel we bought, which is $30. So 40 minus 30 now gives us a $10 capital gain. So much less than the FIFO strategy, but we're still paying tax because it's a capital gain. So remember, if our goal was to pay the least amount of tax possible, what could we do? Well, that's where you can do something called the minimize gain strategy. And what that means is you don't prioritize by the order of date order that you bought things in, like FIFO and LIFO do, but instead we prioritize parcels with the highest price first because it's going to give us the least gain. So if we were running a minimized gain strategy, these 10 shares for 40, we would look through and see what were the most expensive shares we bought in that stock. And in this case, it's this one, $5 versus $3 or $1. So if we now calculate the gain off this, 40 minus 50 gives us a negative $10 capital loss. So not only will we not pay tax on that because that's a capital loss, you can now use that amount to offset other capital gains. Number 3, tax loss harvesting. In Australia, you can offset capital gains with capital losses to cancel them out. So let's say in our hypothetical portfolio here, during this financial year, we made 3 trades and we made a capital gain of $20. Then on the next trade, a capital gain of $10. Third trade, capital gain of $30, giving us a total capital gain of $60. Now, because that is a gain, it means we're going to pay tax on it. Before the end of financial year, this is a great opportunity to look through your portfolio and think, is there anything in here that's underperforming that I don't actually want to hold anymore? I don't believe in this company anymore. Maybe the founder annoyed you, or their earnings report was off, or you've just lost faith in them. This is a perfect time to sell some of the losers and cancel out the gain. So imagine now we had a stock we wanted to get rid of, and if we sell it, we're going to make a capital loss of $30. We'll put 30 in the column here. And then we go through our portfolio and we find, oh, there's actually some crypto in here that we want to get rid of. And that gives us a capital loss of $100. So we'll add 100 here. So if we add all that up, put a line here, that's $130 of capital losses. So what happens now is this $60 gets completely cancelled out by that $130, and we're overall left with a negative $70 capital loss. That capital loss can then get carried forward into the next tax year and cancel out some gains next year. But you can see if we hadn't have made those trades, we would have realized the $60 gain. Now, $60 doesn't sound like much in this example, but think of a bigger portfolio, maybe like your own. This could have been a $6,000 capital gain that we would have paid tax on. It could have been a $60,000 capital gain that we were going to pay tax on. Doing some basic tax loss harvesting means we can cancel out that gain and end up not only the benefit of getting rid of those losers that we didn't want to keep anymore, but it cancelled out the gain we made from the winners. Number 4, how to keep good records. So keeping records is super important, and that's one of the many reasons I built this tool called Navexa. This is a typical portfolio of a bunch of usual ASX suspects and crypto and custom investments, some US stuff in there as well. But if we go into this BHP holding and go to the Trades tab, you can see all the records that we're already keeping in here. So we bought some shares back in 2018. Then we turned on dividend reinvestment, so DRP or DRIP. That created a whole bunch more transactions over the next few years, and then eventually we sold some of this BHP holding. We could absolutely calculate the capital gain on a piece of paper here and file that to the ATO, but in a few years' time when you sell again, you need to know which one of these many parcels that you've already sold. So if we go to the capital gains tax report of Navexa, you can see that with the click of a button, it's calculated for this 23-24 financial year what the capital gain is for the whole portfolio, and you can see there's a couple of BHP records here based off those 2 sell trades that you saw in the transactions list. Now, say we don't want to do a FIFO. Say we're not particularly happy with this $13,000 capital gain and would rather pay a bit less tax this year. So you can come into tax settings and change the strategy to minimize CGT. Now, minimize gain and minimize CGT, just a quick tangent. Minimize CGT factors in the 50% discount that we talked about earlier, whereas minimize gain purely just goes after the highest cost parcels. So we're going to go minimize CGT, click apply, and our $13,000 gain has become a $4,000 gain. If we scroll down, you can now see all the various BHP parcels that we've disposed of. Even some of them ended up being a capital loss, which is a big reason why that tax number came down. Why this is important? Because as an isolated one-off tax report, we can absolutely file it and away we go. Next year, or in 2 years, or 5 or 10 years, when we sell some more of that BHP holding, we need to know that back in financial year 24, which parcels did we actually sell? And that is why the record keeping is critical. So you could do this on a spreadsheet, but it gets quite unruly after your portfolio gets much bigger and much older. So after 10 years or 20 years, you're going to have tons of trades in there, tons of dividend records. Things like ETF member statements have got to be imported. All of that data needs to be tracked, able to be recalled at any moment to give to the ATO. So now I've given you 4 powerful ways you can drastically impact your tax outcome this financial year. If you'd like to automate all of this and make it really easy, check out Navexa, link in the description.